Right now, across the global supply chain, an autonomous AI agent is independently planning a parts order, negotiating the terms, and instantly settling the cross-border transaction using a stablecoin API. No human oversight, no banking hours. This architecture is an adaptation. To understand why it exists, we have to look at this chart, showing three distinct economic forces colliding in the second quarter of 2026. Brent crude oil prices breaking $119 per barrel, massive accumulations in corporate Bitcoin treasuries, and a vertical spike in the megawatt consumption of AI data centers. These curves represent massive capital expenditures. Corporations are deploying billions into digital assets and artificial intelligence infrastructure at exactly the moment when global capital has become brutally expensive. The global market spent the last year pricing in anticipated relief from central bank rate cuts. That relief has evaporated. Futures markets now signal the Federal Reserve will not lower rates until at least 2026. Faced with tightened global liquidity, the most resilient enterprises are no longer waiting for traditional financial conditions to improve. They are abandoning the legacy frameworks entirely. Geopolitical energy shocks, unyielding monetary policy, and the absolute physical limits of computing power have forced a complete architectural rewrite of both the corporate balance sheet and enterprise IT infrastructure. The current inflationary pressure is not abstract. It is tied to physical geography and kinetic warfare. Severe disruptions to the Strait of Hormuz and strikes on Qatari liquefied natural gas facilities have sidelined 17% of the nation's export capacity for the next 5 years. This structural damage to the global energy supply matrix pushed Brent crude to $119 per barrel, baking sustained inflation into the global economy and forcing central banks into their hawkish, higher-for-longer posture. For the Office of the CFO, this reality breaks traditional WACC, or weighted average cost of capital, models. When fiat currency is steadily debased by inflation and borrowing costs remain elevated, predicting the future cost of capital becomes a dangerous guessing game. In response, corporate treasuries are shifting their defensive strategies. Instead of holding cash reserves that melt in purchasing power, public companies are accumulating mathematically scarce digital assets as their core balance sheet anchors. This models the hurdle rate strategy. Companies use their Bitcoin yield as a strict internal benchmark. If a proposed project cannot outpace this yield, it is denied capital. Simultaneously, corporations aggressively accumulating these coins create a persistent supply shock, draining public exchanges. However, utilizing these highly volatile assets requires strict discipline. Metaplanet, a Japanese firm holding roughly 35,000 Bitcoin, illustrates the acute dangers of using digital assets as leveraged corporate collateral to fund further acquisitions. When Bitcoin prices experience routine pullbacks, Metaplanet's equity valuation plunges. A falling share price traps the firm, inhibiting its ability to issue the equity required to buy more assets and service its structural debt. Despite these localized execution risks, the broader trend is clear. Corporate finance is migrating away from unpredictable fiat dependencies, utilizing verifiable digital scarcity to ensure survival during periods of sustained energy-driven inflation. Institutional capital requires legal certainty. That certainty arrived in March 2026, when the SEC and CFTC published a framework dismantling years of jurisdictional ambiguity. The ruling explicitly classified 16 foundational tokens, including Bitcoin, Ethereum, and Solana, as digital commodities. This officially removed the existential threat of the Howey test, verifying that these networks are not subject to federal securities laws. Simultaneously, US dollar-pegged stablecoins matured into regulated financial infrastructure. Propelled by the Genius Act, issuers are now mandated by federal law to maintain strict one-to-one fiat backing, verified by independent monthly CPA audits. The legacy banking transaction is bled by foreign exchange fees and delayed by settlement gates. Conversely, the stablecoin settlement operates point-to-point, finalizing instantly. This entirely eliminates friction, allowing companies issuing fully backed tokens to capture the yield generated by fiat reserves. Yet, integrating this technology exposes corporations to novel systemic risks, specifically at the governance layer of decentralized finance applications where these stablecoins operate. In April 2026, the Solana-based Drift protocol was drained of $285 million. The exploit was not a quick code crack. It was the culmination of a months-long, highly coordinated social engineering operation executed by North Korea's state-sponsored Lazarus Group. The core paradox of the attack is that the automated blockchain code and cryptographic signatures functioned perfectly. The security failure happened entirely at the human level, when administrators were socially engineered into handing over multi-signature keys to hostile actors. Stablecoins offer a highly efficient, programmatic rail for global finance, but deploying them means enterprises must now defend against sophisticated psychological operations targeting human governance structures. While stablecoins automate capital settlement, artificial intelligence is automating enterprise logic. We have moved entirely past responsive chatbots into the deployment of autonomous agentic AI. Enterprises are abandoning single language models for a multi-agent swarm. They deploy orchestrated ecosystems of specialized agents that divide tasks, reason through variables, and seamlessly interface directly with internal databases, completing technical operational sequences without human approval. Industry data shows 88% of organizations experience increased revenue and reduced operating costs from this integration. But that ROI comes with a crippling risk: severe vendor lock-in, where switching proprietary AI providers costs an enterprise an average of $315,000 per project. Furthermore, a governance crisis has emerged. With only 23% of companies maintaining formal agent inventory protocols, corporate networks are becoming infested with unmonitored shadow agents, quietly draining expensive compute resources. Agentic AI automates specialized mid-tier knowledge work, effectively collapsing the traditional corporate pyramid. Organizations are reforming into an hourglass shape: a broad base of junior employees utilizing AI for output, and a dense upper layer of senior executives focused purely on strategic governance. Agentic AI delivers undeniable operational efficiency, but it achieves this by permanently hollowing out the middle class of the enterprise workforce, while threatening to trap the company inside proprietary, high-cost software walled gardens. The software scale of these agentic swarms is currently colliding with hard physical constraints. The immense computational power required has pushed data centers into the thermal wall, where legacy air cooling cannot dissipate the extreme heat. Mitigating this thermal load requires massive infrastructural shifts. Data centers are rapidly retrofitting for liquid cooling, and major technology conglomerates are executing direct agreements to secure thousands of megawatts of dedicated nuclear baseload power. To bypass the immense continuous power draw of traditional hardware, the semiconductor industry is accelerating the production of neuromorphic chips. Looking at this hardware efficiency matrix, neuromorphic processors discard the continuous computation models of standard GPUs. Instead, they mimic biological, event-driven spiking neural networks, consuming power only when specific data pathways are activated, dropping peak loads to roughly 1.2 watts. Beyond physical heat, compute power has triggered geopolitical friction. Realizing that absolute reliance on foreign hyperscalers presents unacceptable security risks, governments are heavily funding sovereign AI initiatives to localize their data processing and maintain national autonomy. The ultimate technological synthesis that solves both the danger of centralized corporate monopolies and the physical bottlenecks of specific data centers is the rise of decentralized AI, or DAI. Instead of a single hyperscale facility, decentralized protocols aggregate latent GPU power from independent providers worldwide, creating a massive computing layer. The network objectively evaluates the machine intelligence produced, financially rewarding the most efficient nodes in an open market competition. Physical thermal limitations and the systemic risks of relying on centralized corporate APIs are forcing the infrastructure itself to adapt, shifting AI from isolated server farms into a resilient, globally distributed compute layer. When we view the macro environment of 2026, three distinct pressures: geopolitical inflation, automated reasoning, and thermal constraints merge into a single, highly optimized transaction. This isometric model represents the new enterprise minimum. It features an autonomous agentic swarm, planning and executing its own tasks, utilizing a regulated stablecoin API to autonomously purchase neuromorphic compute power hosted on a decentralized AI network. This specific architecture bypasses the foreign exchange friction of legacy correspondent banks and entirely avoids the proprietary lock-in of centralized cloud hyperscalers. Macroeconomic volatility forces the adoption of hard digital assets. AI autonomy forces the restructuring of specialized labor, and physical thermal limits force infrastructural decentralization. Financial institutions and technology conglomerates can no longer rely on the insulated infrastructures of the past decade. Those who fail to adopt these API-first decentralized architectures risk obsolescence in a global economy defined by mathematical verification and extreme automation.